During life, an IRA is an excellent asset. It grows tax-free. The minimum withdrawals under the regulations are fairly modest, and it provides both retirement income and liquidity for the IRA owner. However, for the children or other individual heirs of the IRA is not nearly as desirable an asset. Many other assets will be distributed to family or other heirs free of income, capital gains, or estate tax. But with the IRA frequently comes a very large income tax bill. All distributions from the IRA to the individual heirs are taxable income. Worse yet, the IRA payouts, even if stretched over a long period of time, are added onto the recipient's taxable income and could increase his or her tax bracket. There are two attractive planning strategies for IRAs, as we have demonstrated in the previous two videos. The IRA could be transferred to unitrust for surviving spouse. Another option is to transfer the trust for a term of years to children. Here is another workable solution involving children. John and Mary raised a family of 4 children. 4 years ago, John passed away and transferred all of his assets to Mary. She received the house, the CDs, the securities in John's IRA. Mary rolled over John's IRA, added in with her own IRA, and now has $800,000 there. She also has approximately $600,000 in other assets. Mary desires to benefit her 4 children equally, but faces a challenge common to parents. 2 of the children are very good money managers. One is constantly in debt, and the younger one has money just burn a hole in her pocket. If you transfer the assets equally to all 4, the youngest will use the money in new and wonderful ways in perhaps 3 weeks. She asks your advice. When Mary passes away, her stocks, bonds, home, and other assets are transferred outright to children. However, the IRA, since there's ordinary income attached to it, is transferred to a testamentary trust of 15 years. Mary's attorney drafts a unitrust, and her beneficiary designation is then changed to the trustee of the charitable remainder unitrust. Fortunately, under the Section 408 regulations, the formation of the trust does not change her access to her minimum distribution requirement for the IRA. When Mary passes away, her IRA asset is transferred to a 7% unit trust for a term of 15 years. Since the unit trust is exempt, there is no tax paid on the ordinary income. The full $600,000 from the IRA is then invested and earns new income for the children for the term of 15 years. While this is taxable, over $670,000 is paid to the children during the term of years. At the end of the term, the IRA plus growth is distributed to charity. The 3 talking points are: you can show a person how to avoid tax in their IRA, you can create an income stream for children who are somewhat inclined to handle money irresponsibly, the IRA can benefit them while they are alive, their children, and upon their death, their charity, once their children are grown and stable.